Hey everyone, this is Chris with investingwithchris.com, and in this lesson I want to discuss understanding bonds. I think this is going to help a lot of business owners and investors understand how they operate, and also to clarify that bonds do actually assume risk when you're investing in them. A lot of people assume that they're risk-free, but that's not always the case. So we have Joe, the CFO or the chief financial officer of a company. Joe's boss has came to him and has given him the objective to raise capital for a $250,000 expansion of the company building. So Joe's responsibilities are the financing of the entire company, tracking cash flow, analyzing financial strengths and weaknesses, proposing corrective actions within the company, and also strategically growing using investment knowledge and resources that Joe has. So Joe asked himself, how am I going to raise the capital or finance the $250,000 project? Joe has a couple of options. Joe can go to the bank, he can bootstrap, or the company can bootstrap, and that's raising the revenue themselves with all of their profits. That's not any borrowing or anything. Then you have crowdfunding, angel investors, and angel investors are usually accredited investors who invest smaller type investments, and they usually ask for a return of 20 to 25%. And then you have friends and family, and then you have venture capitalists or venture capital, that strategy. It's much larger, a couple million to 10 million, and it's also usually a larger return that you have to pay out. So let's say that Joe decides to go with the bank. Joe will then sit down with the business analyst within the bank, or its top guys that control that bank or who are supervisors and whatnot, and they'll go over the company's financials as you and I would do when it comes to analyzing a company before we were to invest in it. And if all checks out, the bank will then proceed. So what's next? The bank will then proceed with funding by offering 250 bonds. Each bond is given a face value or par value of $1,000, and the maturity will extend out to 30 years with a coupon rate of 10%. Now this 10% is the actual return on investment that investors are getting, and in the industry of bonds it's called the coupon rate. So the bank offers a rate of each bond for 10% due to risk and valuation of Joe's company. Its term is for 30 years. The investors then invest in each bond by buying them from the bank. The bank's value of each bond may be actually a value of $1,005. This is how the banks make their money, by raising the price of the bond itself by a few dollars. So then each investor receives $100 a year for the bond. Bonds are usually paid out twice for the year, and usually in 6-month terms. So 50 times 2 equals the 100, or the 10% of the 1,000. So how does the process work? Joe receives the $250,000 from the bank, and the investors then buy the bonds. The bank then returns the bonds to the investors. So Joe then pays the investors their 10% throughout the course of the time, or in this case 30 years, 2 times annually, or 5% 6 months, and the other 5% the next 6 months. So what happens if the bank doesn't actually sell all the bonds? Joe would then be responsible to pay the actual bank its interest rate. So is it better to issue bonds, debt, or resort to financing off equity? Now, we as investors know that when we buy shares, we get a piece of the pie or a percentage of that company's value. And in this case, that type of capital is only cheaper if the funds fail to increase value of the business for the business issuing stock or shares. In return for bonds, it only offers a flat return without any other obligation. So the company issues bonds, and it knows its flat rate that it will return to investors in the maturity. So who offers bonds to invest in? Obviously the companies that we just discussed, but also state, local, and federal governments issue those. So which is safer? Often companies offer a higher coupon rate due to being more risky, whereas the government is safer but less return percentage. However, there is a misunderstanding when it comes to individuals thinking that government bonds are 100% safe. What happens during inflation? Well, interest rates change and prices change. Now, this is where I discussed earlier that there is a risk when it comes to government bonds. For those holding a 5% bond, The interest rates, if they happen to drop to 2%, they will then be holding a bond that is higher in value. So you'll lose the percentage, but you'll gain the overall value or face value of that bond, because someone would be willing to pay you a higher price for your bond to get that 5% rate that you're locked into. Conversely, when interest rates increase, the face value or par values of the bonds go down. So you have to lower the price to appeal to consumers to buy your bond theoretically. Interest rates are increased by the Fed to help slow spending and control rising prices, inflation, and deflation. This is how the government steps in and controls all that. So I hope this lesson helped you understand how bonds, we as investors can invest in bonds, but also the overall how bonds operate and how companies issue bonds. So if there's any questions, feel free to reach out to me, Chris@investingwithchris.com, or feel free to visit the website investingwithchris.com. And until then, I'll see you in the next video.